Okay, so where we left off was here is the adjusted trial balance. Okay, so I already went ahead and did the deliver for you, and I've already put every single account in here. Now, I think I told you guys yesterday that the number of debits and credits should not change. But I realized that the very first problem was getting rid of a credit and then transferring into a debit. So actually, it changed it a little bit. Just by how the debits and credits actually works. But that's okay. They both came out to be even, 0, on both sides. So here is on the left side is every single account on here, including all the contra accounts and sub accounts. Okay. Now, what I also did too is I also created on the right side in blue, these are summed up, what do you call it? Summed up numbers based on their main account. So, for example, my bank is a total of 5,912 because I added up all three banks. So I added up my bank, my petty cash, and my cash register. So basically, the ones in blue are basically summed up main accounts. And usually for the main accounts, it is 10 times more easier to actually do your financial statements that way. So here I just summed up every single main account. And so all of those are in blue, while all the ones in black are every single account that you see.
Okay, that's the adjusted trial balance.
Yes, this is the adjusted trial balance. So this is after when we completed our depreciation expense, our transfer of inventory, periodic into regular inventory. This is our supplies expense, everything that we've done up to now. All right, so this is the adjusted trial balance, okay? And then once you've completed the adjusted trial balance, that's where you can go ahead and move on to the very first financial statement, okay? So here is going to be what your income statement should or more or less look like. Now, of course, I'm using main accounts to sum up my information a little better and a little quicker. So what I did was, in order to understand how to do the income statement, you're going to take every single revenue, all the sales discounts, all the sales returns and allowances. You're going to combine all of those together, okay? So here, sales, right? It says right here it's 24,000. I actually went ahead and compared that to my adjusted trial balance, as you can see under sales here.
I just have one quick question.
Yes.
Did we do this adjusted trial balance already?
No. I told you guys not to do it.
Oh, okay, because I'm looking all over through my papers saying, wait a minute, I don't remember doing that.
Yes.
All right.
Yes. I told you guys to strictly not do anything but study over the materials that we went over today for depreciation, because that's way more important than this, okay?
Okay.
So here I totaled up all my sales together in one column, and it's blue, and it's 24,000, right? Instead of actually listing out every single account that you have, I already summarized it that all my sales total is 24,000. And that is exactly what I have indicated here in my income statement. I indicated that my total sales is going to be for 24. Of course, sales returns and allowances and sales discounts counter. They are contra accounts, so they subtract from sales. So what I did here is I went ahead and subtracted my total sales returns and allowances for $19. And then I also totaled up all my total sales discounts, which was a total of $1,800. And I subtracted that all from my sales. So here, right here, is the total of my sales in general. Okay? And here I get $22,000 right here. Okay? The next portion is to realize if you have a gross profit. So what that does is it's going to take all your total sales and you're going to minus everything it costs you to sell the item, as well as cost all the materials to get your product sold. Okay, so I went ahead and totaled up my cost of goods sold. Okay, so this number contains all my sales of regular coffee. I'm sorry, all my cost of goods sold for regular coffee, Supreme coffee, as well as my coffee mugs. So here they are in a grand total of $3,000. Now, because I'm subtracting these numbers from my total, that's why they're in parentheses, okay? Just so then I can easily just sum them up easily instead of having to click the minus sign every time or subtract it manually. So here, I started with 22,000. My total cost of goods sold is $3,241. And then lastly, my total cost of materials, which was medium cups, large cups, sugar, and creamer, right? We calculated that in our adjustment. The total amount of that is going to be $997.88. So by taking these two numbers and subtracting it from here, I get a total gross profit of $18,000.706. Okay, so that's my total gross profit. This is me selling a product, subtracting how much it cost me to sell my product. Now I'm going to subtract everything that had nothing to do with my actual business in selling coffee, right? Because ultimate goal to understand how income works is you need to make sure that your sales covers every single cost, including all of your business expenses. So anything to operate the business, okay? That is a true profit right there. So in this case, I went ahead and I gathered all my information. So operating expenses, that is everything, all the accounts and operating expenses that we incurred. So for example, we had advertising expense for $185. We had bank fees, which we recorded earlier for $479. We had business expense for $1,282. Insurance expense, okay, labor expense, license and permit, all of those, every single account, you need to calculate every single operating expense you had incurred for the month of June. So the last thing that we had was amortizing expense. Okay, so this one you can just grab this right in your adjusted trial balance. Underneath everything, you're gonna have all your operating expenses down here. Okay, and you're gonna grab all those numbers and transfer it to the income statement, which I did right here. And then on the right side, okay, when you look at this doesn't mean debit and credit anymore, right? At the top of the bar, it doesn't say debit or credit. So this is us making our calculations and totaling up the columns. That's all it is. So here I'm totaling up this whole entire column and I get a total of $10,000 in expenses. Holy moly. And because I'm subtracting it from my actual profit, now I get a different number. But also, I also have to include any other sources of income. So I did have one, which was my delivery income, right? It was a separate charge apart from my actual business. I'm not in the business of delivering. I'm in the business of selling coffee. So this is any other income, and we're going to add that $240, and we get a total profit of $8,630.48. Now, this number is going to come into play, especially once we solved for every single financial statement. This is going to be very, very prevalent. Okay, this number is your key to making sure that everything that you've done so far was accurate. All right, by this number right here, this net income right here. So we know that we had a total of $8,000 in profit. Okay, and then we can go ahead and move on to the next sheet. So that next sheet is going to be the statement of equity, of owner's equity. This one is straightforward, right? First thing that you're going to see is, well, what did you start your company? What was the value of your company to begin with? In this case, we barely started our company, so we started off with $30,000, okay? Next thing that you're going to add is going to be your income, right? Because if we're reinvesting to our company, right? This is us saying, well, we gained a profit. So that means the value of our company should be worth more than $30,000. And it is worth more than $30,000. However, we've also taken money out of the company. So remember, we had owner's withdrawal because we were thinking, hey, Mr. Bob Mason's the owner of the company. He's saying, I'm not going to run my business for free. I'm going to pay myself $1,500 twice a month. So, twice a month. So therefore, every month I'm going to pull out $3,000. So in that case, because it's going to go against the net income, because in a sense, we're looking at the income, right? We're going to pocket $3,000 worth of it, and then we're going to dump the rest into and reinvest into our company. So this is exactly what it's showing us right here. We had $8,000 income. Now we're going to subtract the $3,000 because that's the money that we took out previously, right? We're reimbursing that payment. And now we get a total of $5,000 investment. And because it's still positive, we add it to the $30,000, and now our new equity is going to be for $35,630. So that is our new value of the company as of June 30th. Okay, so we started off at $30,000. Now we gained $5,000 in value. All right. Once we solve for this, the next portion is going to require that, okay? So again, when we do the balance sheet, our main goal is to compare all of our total assets to our total liabilities and equity. Equity, ding, 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 we already solved for it in the previous equity, my $35,000. I've already calculated doing it by using the statement of equity. Okay, so this part is already done. Now it's truly looking at all of your permanent accounts, so all your assets, right? You're gonna go through every single thing. Now, of course, I put main accounts, so these are just my total of each main account. And again, usually the total of your main account, it actually concises your financial statements a lot. It's a lot cleaner, a lot better. So I did it this way. So here is a list of all my main accounts. So I have so here I have bank, I have my accounts receivable, allowance for doubtful accounts. Okay, so it's a tricky one, but I went ahead and inserted it in here, and you'll understand why. Actually, never mind, there is no later. I was going to say later, but there is no later. But the reason why we don't merge it into the accounts receivable is because this is a possibility of us actually earning this money back. So we kind of have to keep it astray. Again, it is a contra account. However, that money can go directly back into accounts receivable. All right. Business supplies. Okay, we have it there. Office supplies, inventory, XYZ, pretty much any asset that we have under our assets. We listed all the accounts. Huh?
At this point in time, don't you figure writing off loss to doubtful accounts as a loss?
Um,
Or you?
yes, that happens. That happens in the next step. In the next step, we'll do it. This is just recognizing it, okay? Okay, so here, yeah, okay. So once we list all of our assets, right? Notice, right? We had goodwill. It was for 2,100, and we just revaluated to $2,088, right? Because if we look here in our adjusted, under that very same exact one, so because they're contra accounts, um, they can be combined together to show like a total of a main account, right? So the main account is goodwill. This is just us showing us that that's the sum of what goodwill is, but it also includes the so here goodwill. It also includes the goodwill amortization expense. So again, we're showing that it's losing value, but in reality, if we expand the account, it is actually the same amount. It's just slowly losing its value because of depreciation over time. Okay. So that's for that one. But again, when we're looking here, we're just gonna look at just the main account and what it stands for right now. So as of right now, it's got 2,100 worth of goodwill. However, it also has an $11.67, I believe, of accumulated depreciation. It's losing its value. Okay, so we want to recognize that value here for our balance sheet. Okay. Because in the future, those assets are not going to be worth the same. We might sell it. So XYZ. Okay, so here I have a total of 72,380. And then I go ahead and list all of my liabilities. And in here we have a total liabilities of 36,750, plus we also have to take an addition to add the new equity that we just solved for, and boom, we get the same exact answer, $72,380.78. So here we can ensure that the accounting equation holds true, that all my total assets is equivalent to my total liabilities and the value of my company. So that's how you do that one. This one's pretty straightforward, but again, this has to happen after the adjustments. All right. And again, this also isn't a debit and credit function, okay? This is just one row is to calculate all your debits, like all your assets, and then the other row is to calculate. It's just a cleaner way to organize your information versus having things here and here and here. So, in this case, that's how I organize it, is to just have all my assets on the left side and then all my liabilities and equity on the right side. Okay, so financial statements do not reflect debits and credits. Okay, financial statements are its own separate way of how you want to organize your information. The next statement, I don't know how to describe this, but I'm gonna tell you this is not as important as the other three criterias. Reason being is I don't want to explain this until Thursday, just because I'm not going to test you on this, and even Mr. Sanchez doesn't test on the statement of cash flows. It's just basically converting all of your accrue accounts, so such as accounts payable and accounts receivable, right? Your assets. All it is really doing, it's liquidating them into cash, just so that it shows you how much cash really is flowing into your company and how much cash are you actually spending and flowing out of the company. So it's basically converting every accrual account into cash and just liquidating into cash. So this one is pretty straightforward. It's kind of easy, kind of hard. Just depending on how you organize your information. I will tell you the general location of where everything usually is. So you're you obviously the first one is going to be your net income. Did you have a net income? That's what you're going to start off with. Okay. You're going to have three general categories, and it's going to be operating activities, investing activities, and financing activities. Now, generally, how I look at it is your operating activities is going to be your current assets as well as your current liabilities. Okay, so you're going to convert your current and other assets. So current and other assets and your current liabilities, you're going to convert them into cash. Okay, so for example, accounts receivable, right? You have to kind of think about it. Is it cash that you have or is it cash that you will have? So in this case, it's going to be cash that you will receive, but you don't have yet. So therefore, you need to subtract it from your actual total amount of cash that you really do have. Same thing with accounts payable. Did you pay them yet? Then technically you still have that money. Okay? So it's going to flow in the opposite direction of how you convert each one. The second portion is called investing activities. This is normally where your fixed assets are going to lie. So again, and this is in a sense where, well, hey, what if I sell my assets? It could be easily converted to cash. So what you're going to do is you're going to place your assets in here, and it's going to be valued at what you originally bought it as, and you're going to just convert that to cash, quick cash. Okay? And then lastly, anything that you owe is a financing activity. So example, a loan, right? You were given a loan, meaning you were given money to buy a car. So therefore, you need to calculate that as a financing activity because ultimately you were given some kind of a lump sum of money. So long-term liabilities usually reside in the financing activities. And then you're going to compare that from the beginning that you started with your cash in to the end number of what you started you ended your cash in. Okay? And usually they should come out even. For the years of doing this coffee cafe, I've always been off by $30-something, and me and Mr. Sanchez tried for so long now. It's been a year and a half since I've been doing the same exact project, and I'm still off by $30 or even $60 sometimes. So every time I readjust this, for some reason I don't know where this missing money is coming from or what account I forgot to enter here, but that's the general way how you fill out the cash flows. Again, I'm not going to test you on it. It is definitely something that you can do in QuickBooks, because QuickBooks you can just do it by pressing just a click of a button. So feel free if you want to mess around, go ahead and take it upon to yourself to try to figure out how to do the statement of cash flows using QuickBooks. Okay. Other than that, then we move into the post-closing trial balance. Now, this happens after you've closed up your books. So if you guys remember from the PowerPoint, here I finished my adjustments, right? So I'm going to come back to my my general journal. And what I'm going to do is I'm going to start zeroing out every single account that I have. Okay? Only revenues and only expenses, because permanent accounts you cannot ever close. Why? Because they still hold a value. For example, your bank. Are you going to close your bank account?
No.
Exactly. If you close your bank account, you can't do business anymore.
Yeah, you
Okay?
just zero it out and make it inactive.
Exactly. So in this sense, how I interpret sales and expenses is you will never incur the same exact sale every month. Now, you may have a same exact customer come in every month, but how they order, they may order a regular coffee today, they can order a supreme coffee tomorrow. They can buy the wholesale pound from you. You can never determine, you will never ever have the same exact transaction occur within the same, in different months. So this is why we close it out, so we can have some kind of way to measure whether our company is doing good, whether it's making good profits. Did we have the same customer? Did we have new customers? You're always going to have something different occur every month. Same thing with expenses. This month I had a party, so I incurred a business expense, right? But am I going to have a party next month?
No.
I might. Maybe we hit our first 100 customers, and I want to be like, heck, I want to celebrate it. All right? So that's this is exactly why I'm saying, like, you're not going to incur the same amount, okay? And then we have other things like utilities, right? Maybe because we started in the middle of the month, your electricity bill is obviously going to skyrocket the next month because you're using a full 30 days. Where in the month of June, my statement was only half for 15 days because I started my business on the 15th of June. So do you understand what that means? Like, so my expenses for every single month will vary. It's not going to be a constant same exact number. So this is exactly why we close them out, because it is a good measurement of whether we make money or not, whether we make a profit or not, or maybe this month I have to incur more expenses than I did before. So it all depends. So every month is going to vary upon that. And what we're going to do is we're going to close them out, meaning we're going to zero out every single account, and we're going to close it out to this little account called income summary. Now, on a corporate standpoint, you're going to close it out to retained earnings. But under a private or small business or sole proprietor, you're going to close it out to income summary. Okay? And I believe your QuickBooks will explain that in terms of understanding what the difference between corporate is and a small sole proprietor business. Okay, so that's the only difference that we'll see here is instead of closing out to retained earnings, we have an income summary. All right, so we're going to close out all of our revenues. So how do you close out an account? How do you zero out an account?
Oh, if you do the opposite, if it's a debit, then you do a credit.
Exactly.
Credit account.
Exactly. So here, this is an example right here. My sales normally has a credit balance. So in order to zero it out, I'm going to debit all my sales.
Yeah.
Ooh, I just realized this is wrong because sales returns and allowances is a okay, so this one I have to fix. But yes, so you have to also make sure that you understand the flow. I think I was in the middle of fixing this. I was about to enter it in here. So you have to also understand the flow of how you journalize or post to the ledger. So in this case, I posted my sales returns and allowances, right? All of those are going to be my they normally have a debit balance, right? But in this case, what I'm going to recognize it as, it's going to be since I'm zeroing it out, I have to create it as a credit balance. So it's going to look like this. So here, delivery income. Okay, so I'm going to zero all my accounts. So I was just about trying to fit in all the numbers, so that's where I'm at right now. So I'm gonna go ahead and continue and try to finish this off. But what you're gonna do is you're gonna list out all your accounts. Make sure you understand which flow and which order you're gonna put them in. Okay. So in this case, all of my credit accounts are going to be debited, and then all my debited accounts are going to be credited, and it's all going to go into the income summary. Okay. So in this case, I'm going to go ahead. Let me see, delivery income, I believe was 240. And then my sales returns and allowances. Let's see what sales and returns and allowances was for. Okay, so I did not have interest income. Delivery income was the last thing, and it was for 240? All right. So here my sales discount was for a grand whopping $1879.59.
Yes.
Okay, so I'm gonna go ahead and credit that because right now it's currently a debit balance. So I'm gonna credit my sales discount for 1879.59. All right. And and what I'm doing here is I'm entering in everything simultaneously so that I can do this a lot quicker. So if I were to just do this, right, I'm gonna put close and what it says, general journal 21. If I were to put this on the credit side, right, I'm gonna go ahead and expand my formula so it calculates everything. If I were to go ahead and type in right here on the credit side for 1879.59, right? Just what it says in my journal, right? I credit it. Boom. There, my account is zero completely, okay? So you also want to ensure that when you type in those numbers that they're both accurate. So I believe I have one more left, which is this one, sales returns and allowances. So I'm going to go ahead and enter here for closing for general journal number 21. So in this case, my running balance is right here. So I have a debit balance of $19.96. So here, I'm going to write here in the credit side, 1996. Right? I credit my account. So here, I'm going to also type in 1996. And boom, it's zero. So I'm for surely okay with that. Like, I know for sure those accounts are zero. Now, if I were to... Oopsies. I typed in the wrong one. So 1996. This one's 187.959. All right. Now, what I know is that these totals have to match. So if I were to equal sum this. Okay, so I sum my total sales that I'm debiting. Okay, so it should be $25,084.64. And if I know that my number should be 25,084.64 minus 1996 minus 1879.59, I know that my total income summary needs to be 23,000. And if I were to verify that these are equal, so I can go ahead and equal sum this, I'd be able to say, hey, yes, they do equal. They're both 25,804.74. So that means now that I enter all of those information in my accounts, I can also update my equity account. I go to my equity account. All right, this is part of your exam, okay? Be sure that you know this. Once you zero out all your revenues, you're going to make a note in your ledger saying closed out revenues. All right, you're going to make a note, general journal number 21. And it is for a credit balance, okay? So notice that I wrote it on the credit side. So I have a credit balance of 23,185.09. Okay, so 23,185.09 is going to be my credit for my my whatchamacallit, my income summary. Now, in order for profits to happen, you're generally going to have a debit balance, but in this case, I can recognize that right now I currently start off on a credit balance, so it's good to start off on a credit balance like that. All right. Once you've closed out all of your revenues, okay, I had to skip this whole part, so I'm going to go ahead and draw a huge fat line on that. Come on. And I think I'll... okay, so... ooh, where'd it go? So there's my line. It's right there, okay? So that means there's no possibility anybody can write something in there. Why? Because the next part is we're going to close out into income summary all of our expenses. Yay! Fun.
Wow.
Yes. Okay, and let me see. Let me just make sure that these expenses don't have debit balances. I don't think any of them do. Generally, they don't because they are, not many of them have contra accounts. I think they all look good. So again, you're going to go through every single account on here to get a sum number for your income summary, right? I'm going to go ahead and do this offline, but just to tell you in advance, so after you've done all of this, you found all the answers to all, not all the answers, but all of these numbers, right? You placed them all in here. You're zeroing out every single debit account with a credit, okay? And you're going to debit them all into the income summary. What you're going to do is once you put this number into the income summary, you should get either a credit or a debit balance, all right? Once you get a credit, you're more likely to get a debit balance in this case. I mean, a credit balance. So what's going to happen is you're going to zero out the income summary into equity, okay? And I think, oh, not equity. It has to be owner's equity. So it's going to be a two-step process, okay, to close out properly. And once you reach to this conclusion, when you are here, let me go back to that.
So we do all of this in the journal. And then
Yes.
go to the procedure.
Exactly.
I mean,
Uh-huh.
get the balances.
So we're basically just transferring stuff from one account to another, okay? And we're only utilizing the journal and the ledger for now. So once you've done that, once you've cleared out all your income summary into your equity, okay, the last step is you also need to make sure that you adjust your equity because you took money out of equity. Remember, we had owner's withdrawal. So make sure that you also update the new balance with that. So EQUIT. Okay, then. So we're going to close out our withdrawals into equity. And once you've done that, that's it. You're done with your entire books. And what happens is, if you did this correctly and you zeroed out everything or you calculated everything, your equity here, okay, after you've journalized this, your equity account, so here in the ledger, right, you're going to update it and make sure that the ledger is also updated as well. The value of your equity should match 100% to the equity that you've calculated in your statement of equity. If this and that does not align, you probably missed something as far as piecing these files together. Maybe you
The balance for 35, 630, 48.
correct. That is your reference point to make sure that you did that correctly. As in, after you've again, when you're in the ledger, after you've entered your income summary, after you entered your withdrawal, it should reflect this exact right here. So, and then that's exactly what it should happen is you're supposed to add your profit and subtract any withdrawals, and you should get the same exact number here and in your ledger. And once you've done that, and you've properly closed out every single account, that is where you're going to go into your post closing trial balance. Now, this is just to ensure that, to basically confirm that equity is the way it says it is. Okay, so it's going to reflect your balance, not your balance sheet, your balance sheet should reflect everything that's going to be in your post closing trial balance. Okay, so here that's what's going to happen is when you fill it out, and this has to happen after you've posted all your closing accounts in your journal. So here we've only done the first half, which is calculating all of our total revenues and zeroing them out by either debiting or crediting them out. And oftentimes it's going to be a debit if you're crediting, if you're zeroing out your revenues, and then if you're zeroing out your expenses, they should be credited. Okay?
I just want to ask one quick question.
Yes.
When we're doing, this is on the test, right?
Similar.
Oh, okay, because I was going to say, if we have to go back to check that the system won't shut out if one of us will, for, the time that it would take to do these entries.
Trust me, like I said, the scenario, the most that you'll have is like, you have 9 journal entries, okay?
Oh, okay.
And some of those accounts are also reused. So it's
not anything like this.
it's nothing like this.
Okay.
Compared, I'm only asking you to journalize.
Oh my goodness.
You're only asked to be journalized 9 things. Yeah. So what I'm going to do for you today is I am actually going to take the time to complete this, have the full answers by sometime tonight. Now again, I actually want to see if we can do the review first, and then if we have time in the end, then I can go ahead and complete this while you guys are in the classroom, like have it completely done by class period is over. So right now it's 2:30, so I want to go on a quick break, come back, do a quick study session, and if we have time, then I'll complete the rest of these statements. But yes, again, all of this information will be posted.